What is up, guys? It's KOJOFOREX, aka GBP Emperor, aka Emperor of Blues. Today I come with you with a very brilliant, very detailed, very involving video titled How to Master Sniper Entry in the Lower Time Frame. This is one of the most important videos that I've ever shot for you guys on YouTube, because guess what? I'm delving into several concepts that you've ever heard about when it comes to trading on the market, and then demystifying the whole nature of lower time frame and how to even find trades easily in the lower time frame, right? So you really want to take some pen and paper, jot down every information that I put out, because it's going to be loaded and packed. And if you think that you're just going to be able to watch the whole video and then capture all the information I'm going to put out there, you're going to be mistaken. So yeah, briefly, just smash the like button, subscribe to this channel, and go grab yourself a pen and a paper, come sit down, and then let's get right into the business. So one thing you must know is that when it comes to lower time frame, we are talking anything under the 1 hour time frame. So it may be the 45 minutes, maybe the 30 minutes, 15 minutes, 5 minutes, or even the 1 minute time frame. But when it comes to me specifically, I try to find a balance between all this time frame that I've mentioned, and then that leads us to really focusing on the 15 minutes. So ideally, for an intraday time frame that makes up for scalping or day trading on the lower time frame, then you can really play anywhere between the 15-minute time frame. So for the purpose of this video, we're going to be using the 15 minutes to do our trade analysis, right? So I'm going to be teaching you all the things that you need if you truly want to call yourself a day trader, a scalper, whatever it is that has so much confidence and so much authority on the lower time frame. Right now, remember, when it comes to lower time frame, there's so much going on in there, because if you're talking about a whole daily candle, right, it takes several 15-minute candles to come together to make that whole one daily candle, right? Several minutes or 15-minute candles put together to make that daily candle. And then even if you talk about a 4-hour candle, we're talking about 6 4-hour candles making a whole 1 day candle. So it tells you that there's so much activities going on in one particular trading day. And then once there's so much activity going on in one particular trading day, it means that on a lower time frame, such as a 15-minute, there's going to be so many patterns, so many formations, so many technical concepts that you've ever come across. But what if you do not have all these concepts in a chronological manner in your mind? You're going to be very displaced. You're going to be all over the place. You wouldn't even know how to start from where, because for once, you know that, okay, somebody taught me support and resistance. I'm looking for support and resistance today, but I'm not finding on the market. Does that mean there's no setup for me today? You're going to be all over the place. Or perhaps the strategy that your mentor, whoever you learned from, taught you was trend line, and then you sit by the chart and you're literally waiting for trend line setups, and you're not getting on an intraday basis. Perhaps you may have come across, learning, about order blocks, SMC concepts, whatever it is. But for that particular day in time, and then whatever currency pair you're watching, you're not getting that trade setups. That's why I'm trying to tell you that as a lower time frame trader, you need to have all those chronological information that I'm going to literally list out there for you, well arranged in your mind, well informed, and then you can now tackle the market. Why I'm saying that is that on a day-to-day basis, you're going to be seeing several of these patterns occur. But once you have those patterns, those information, those knowledge, you can clearly sit on the market. And once you identify that this is the concept that is playing out, then you can apply that concept or that strategy to trade the market. If you see another thing, this is what is playing out, then you can be consciously aware and trade the market according to that. So without wasting much time, and then without leading you on so much into the talks, let's get right into listing those necessary concepts and information that you need along your journey. First one is market structure. Right, so if you really want to do well in lower time frame, you got to really understand market structure. And market structure is very simple. It has everything to do with understanding what higher high, higher low formation, lower high, lower low formation, and basically change in market structure. Right, so if you talk about higher high, higher low, is the pattern of formation that makes up for an uptrend. Lower high, lower low formation is a pattern of formation that makes up for a downtrend. We have the consolidation phase. The consolidation phase usually characterized for a continuation in the pattern or a break of structure and change in direction in the market. I'm going to show you guys practical aspect of that, so don't worry. Next thing you got to understand also is demand and supply. Right, so when we talk about demand and supply, you can also call it support and resistance. I like to not make any differentiation between demand and supply, support and resistance. To me, they are the same thing. You got to master it. And then you got to eradicate the old school perspective of looking at demand and supply, and then adhere to the new school perspective, right? So in this video, I'm going to show you the new school perspective, right? The old school perspective is that we want to find several regions where the market has been bouncing off several times, and we call that place the demand region, or several places the market has been bouncing off, then we call that place the resistance region. But in a new school perspective, I'm going to show you something very brilliant, succinct, straightforward, and then it will change the way you understand supply and demand, or support and resistance. The next one, which is very important but less even spoke about in these days YouTube when it comes to even forex market, is the chart patterns. You also need to understand all the variations of chart patterns that there is, right? Talk about chart patterns, I'm talking about the head and shoulder. You have to be able to not only know them but be able to identify them on the market. Talk about the head and shoulder inverse as well. Talk about the flag patterns, right? So flag pattern, we're talking about bearish flag, bullish flag. Talk about pennant structures, right? Bearish pennant, bullish pennant. Talk about wedge patterns. Talk about rising wedge, falling wedge. And finally, the triangle patterns, right? Which is like bearish triangle and then a bullish triangle. So you really have to have all these information right off in your head, and not only just being able to have them off in your head, but being able to identify and see them and trade them when you see them on the market. Next thing that you want to be so good at when it comes to lower time frame trading is trend line, right? So trend line has everything to do with even the way market structure plays out. So if you remember just briefly when I talked about as a market structure, for an uptrend we are looking at what? A high low formation. So because we have a rising highs and rising lows in subsequent manner, you can usually trace a trend according to that pattern and then have a trend line playing across. Right, so it could be a bullish trend line holding off as a support on the subsequent build up, or a bearish trend line holding off as a resistance in the subsequent build down. You can also identify channels in the lower time frame. So channels can somewhat look like the flag patterns, right? But it's slightly different, because for flag patterns they are usually compressed, but when it comes to the channels they are usually like spread out, right? You can see that they are literally spread across, and then the market is literally trading in between, bouncing off support, resistance between those channels, right? So you have to be able to identify channels as well. Then you have to also get your hands fully on Fibonacci, because remember, the market does not trade in one direction. It goes up, it takes a breather, reverses, and then gathers momentum to go up, right? So within that brief phase of taking a breather and then gathering momentum to go up, it is literally making a retracement, which we traders can use the Fibonacci to measure that retracement level, probabilistic levels where it's going to what give us the information that market is likely to continue from here. And the next thing that complements so well with using the Fibonacci tool is the candlestick pattern. So if you really want to do so well with Fibonacci, then you also have to master candlestick patterns as well. So remember that I've been mentioning several lists of things. That's why I told you guys that if you really want to go so well into this video and then be able to understand everything that I'm saying, just take a pen and a paper and then jot everything I've been saying. So without wasting my time, I'm going to go right into the chart, identify on a chronological manner, just the way I've listed some of these patterns that I've talked about. Let's see how on an intraday basis, using the lower time frames, specifically the 15 minutes, we could have been, catching trade entries on this. Remember, I said it's one of the most important videos that I'm shooting for you. Already, if you're just soaked into it, then smash the like button. Let's get about 1,000 likes on this video within the first 30 minutes to an hour, and then make sure that you are subscribed to this channel as well. We've already been talking about lower time frame, looking at the market and making an intraday trade decisions. So remember that when it comes to an intraday decision, you're literally watching at activities that happen in the market or that are occurring gradually in the market over the course of the day, and then you're using those information to find trade entries. It can be very daunting and very stressful process, right? So clearly, as you can see from the chart, I'm watching the pound Japanese yen, and then if you can watch this chart, you can see that I have this very thin vertical line cutting across here. This vertical line literally tells me that this market started trading from this way, so it's more like a period separator for the daily range. So it also tells me that this is the whole activity of this market from Friday. So Friday opening from the Asian session, traded this range, London session open, continuing up, and then the New York session just consolidating sideways, right? So that's just how the pound Japanese yen decided to trade last Friday. But how could you as a trader take advantage of this, right? And how can you interpret this information that is happening here to make any trade informed decisions? Remember that I've mentioned so many of these concepts. I've mentioned market structure, chart patterns, I've mentioned just various stuffs, right? So for you to be able to make any informed decision in a particular setup like this, you have to really assess what the market is doing and then ask yourself that, can I break down this market using chart patterns? Can I break down this market first off, even with market structure? So what we're going to just seek to do is that we're going to be using the pound Japanese yen as a very typical concept of watching the intraday basis and then making informed decision to trade. So we're going to be using all the concepts that I've listed, and then as and when we see any one of them play out, then we're going to see if we would have been able to catch a trade using those reasoning. So yeah, we're going to be using the replay button to just quickly go on with this. Now if I forward this one, I don't really see any reasoning around this range to give me the decision to sell this market yet, because obviously we're still in that bullish market movement and then the market just opened. There hasn't been any bearish reversals around this region to give me the information that we're going to sell around here, right? Yeah, we do break that region and then the market just starts trading all the way down. So it's not even necessary to have this here. Perhaps even put it up to this high here. The market literally just sells off, no reason to make any trade decisions, and then it starts to trade sideways, right? Now, if you remember what I just told you with respect to chart patterns, then you can clearly identify that here we are making some form of a bearish flag pattern, right? Or you can call it that wedge pattern. So you can clearly see that when we lower this onto, like, let's say the 5-minute time frame, then this one has been just, trading on and off, bouncing in between this region, and then goes up, comes back down, goes up, comes back down, and goes up. But one thing you must understand is that when it comes to that wedge pattern, when you have like a bearish wedge, which means that the market actually started selling off before it started with that wedge pattern, it usually has a continuation onto the downside, right? So with this example, let's see if indeed this market does break down onto the downside. Lo and behold, then it does actually break down onto the downside. So all I'm just trying to tell you is that because you are so much aware of this wedge pattern and then the scenario it creates, then you will know on an intraday basis be finding an entry within a prime range that allows you to, risk just less amount, right? So in this kind of an instance, if you have any reason to jump in at this very range here, then that's where you're going to find that very smooth entry. With me specifically, on an honest basis, I'm not really going to be finding anything that's going to be meaningful to tell me that KOJO, let's sell here, because there's going to be a breakout. So I might likely just miss this trade setup, right? But going on, let's just see what happens. We kind of just observe random sideways movement again on the market, right? As you can clearly see from here, if we connect these dots again, right from here to here, and then right from here to here, then we have some form of a triangular pattern going on here, right? So you can clearly see that here we had that wedge pattern, here we're having that triangle pattern. And then for triangle pattern, the resultant effect is that usually the market would break and continue on the downside, especially when it's like a bearish triangle, right? So here you can see that we had that flag pattern. Here we have this triangle pattern trading sideways in between the market, right? Let's see what this market just does from there on. So slightly missed our stops and then just continues all the way down like that, right? Again, creating that sideways. So this is just what I want to just bring to your light, that on an intraday basis, there's just so much going on. And then as a trader, you have to be able to interpret all this information that is going on. And then if you don't have that necessary knowledge to interpret this information, guess what? You're going to see things play out and you don't even know exactly what is happening on this market. So again, you can clearly see that the market creates another continuation pattern, which is similar to what we had seen here already, which is that bearish flag pattern, right? And guess what? It still continued to trade all the way down. Now, one important thing that you must remember is that the market on the previous day, when it created this low here, already served this region as a support level. Somebody can call it a demand zone, right? But here I would identify that range as a support level, right? So as a support level or a demand zone, all you're expecting is that this market is going to come back into this range again, give us some level of, consolidation, rejections within this area, and then perhaps do what? Bounce off from here. And if it does not bounce off from here, then we'll be looking that this market is likely going to break all the way down from here. So as snipers, we're just going to be waiting in that zone and then specifically targeting that. Is this market going to give us the scenario we're waiting for to break off, or it's just going to break all the way down and then continue trading in that bearish direction? So let's see how this one plays off. Comes right into the zone, consolidates a little bit, and then off and off it goes, right? So you can clearly see that here you're going to literally be risking very minimal, let's say barely about 20 pips, and then you already have the market running about 100 pips, and then so on and so forth, if this thing, if indeed even it does fly all the way up like that, right? So all I'm just trying to display to you in this video is that as a trader, when it comes to the lower time frame, there are several information that you need on a day-to-day basis before you can actively trade it and be a master of the lower time frame. So we've been able to break down structure side of market structure, and then patterns such as the flag pattern and then the triangular pattern. We've also briefly touched on the support resistance concept, specifically using the demand or the support level in this particular scenario. Let's try and identify several other intraday information that we could have been using when you follow the patterns or the list that I've clearly set out for you. Here on AUD/JPY, we can clearly see that in this market, then we can see that it's also basically following that trend line pattern. So this is basically the same concept that I used in my previous video when I talked about trend lines and then lower time frames. And then at that particular time, the market was still trading around this region, right? And then I use the same concept to tell you that if you really wanted to follow that pattern, then you could have been identifying the first touch here, the second touch here, and the third touch here, right? And then it did actually play out. So guess what? If you really remember the lessons I taught you from my trend line concept, I told you that after you've had that first touch, second touch, third touch, what do? We adjust the trend line, still maintaining that first touch and only just extending the second touch, and then expecting that some way, somehow in the future, we're going to have that third touch and then the market is going to bounce off. So we're going to be expecting a scenario like this in the market, and then expecting the market to, trade off in somewhat of a manner like this, right? Let's see, fast forward, what this market actually does in a scenario like that. So yeah, once it hasn't come into the zone, there's no reason for us to trade, unless of course you have any other confluence for this setup, right? Another confluence that will likely match this if you're trying to use the Fibonacci, because if you do extend the Fibonacci from this range all the way up here, then you can clearly see that the market comes back into the 61.8 retracement region before it does take off, right? So in that kind of a manner, you may be expecting that maybe the market should come and break these regions and then continue all the way up. So it could be an intraday setup for you if you care to take the setup based on that intraday basis. So you're just going to use your Fibonacci, measure that swing point. So remember that all I just did is that the market took a swing point off like this. It made a retracement, which is a pullback. In a normal circumstance, if the pullback didn't hold, then the market may have come into the trend line area. But because the pullback held or the Fibonacci zone held, then the market is making that continuation up. So perhaps trying to visit this previous resistance region, or let's just see how it eventually plays out. But that's the concept that you should have in mind, right? So yeah, we are still hopeful to expect that is this market going to come back into this trend line region. Lo and behold, then this market actually does come back to tap into this trend line reading just quickly, so fast that if you're not really an intraday trader sitting by your chart, you may end up missing that setup, right? So here you want to put your stop loss just below the trend line and anticipating that this market is going to visit the highs again. Let's see how things do play out within the same setup of a region. So there you have it, the market literally coming back and then fulfilling this. So if you remember from the concept, I already told you that you would have had 0.1, 0.2, and then 0.3 from the previous week, and then subsequently 0.1, adjusting it 0.2, and then the new one giving you 0.3 to satisfy this trade setup as well, right? So this is typically using that trend line concept. When you look here on US oil, this is a very typical example of an inverse head and shoulder. So those are usually the most easiest of patterns to even trade with, right? So all you can identify is that, well, the market made this low here, came up, decided to break that low. Here it was very influenced by fundamental, obviously, but just creating that sort of a head pattern in this, consolidating with this region, and then coming back to create. So here we have the left shoulder, then we have the head, and then the right shoulder in an inverse format. So we have the inverse head and shoulder, right? So the normal head and shoulder usually have the left shoulder, the head, and the right shoulder, and then subsequently breaking that range and continuing down. But the inverse one, you can see, is the transverse of the head and shoulder pattern. So here you'd be expecting that as a trader, once you've been able to identify that we've made that left shoulder, head, and then we are coming right into that right shoulder, then you're trying to, find your entry within this range of a right shoulder, right? Sometimes the market can act very quickly within this range. If you're not a day trader or a scalper, you may end up missing some of the leading way to cut this kind of refined entries. If you even want to lower into extra lower time frame, like the 5 minutes or even the 1 minute time frame, but it's a kind of move that you can easily miss if you're not actively settled by your chart. But you can clearly see here that that head and shoulder actively also plays out perfectly. So if you can observe from everything that I've been running you guys through, it gives you that in-depth understanding of how laborious of a work is required if you want to call yourself a day trader or a scalper, right? Name all the big day traders or the big scalpers they go through so many strenuous effort to catch trades on a daily basis because they are combining several concepts, several reasonings, several mechanisms, just as I've typically explained all of them for you. So you want to do your homework and even dig deeper right from where I've ended in this video. Without wasting much time, just smash the like button like I said. If you want me to continue these video sessions and then even teach you more into this intraday basis, then you want to make the like button hit 1K or maximum even 2K within the first hour of this video. Click in the link in the description to join the KOJOFOREX Telegram community. Also sign up with my broker, recommended broker, XNES in the link in the description as well. And subscribe to this channel if you haven't done that. Let's hit that 100K mark. And connect with me on all social media at KOJOFOREX. Without wasting much time, I hope you guys really did digest and then enjoy this information. I'll see you guys in the next video. Peace.